Is it time to get out of Alibaba stock along with various different Chinese stocks? You've seen that happen with Ray Dalio's Bridgewater, where they blew out of Alibaba stock in the second quarter of 2022. By my estimates, over $1 billion cost basis for their Alibaba position alone, facing a significant loss. You can see that they trimmed several of their previously top positions, but Alibaba, they did sell all of it. And for your own information, you can check out various different hedge funds, what they're doing at whalewisdom.com, so you can see for yourself. And it's not just Ray Dalio's Bridgewater. You can see SoftBank, which was arguably one of the first investors in Alibaba, invested initially something like $20 million, and they're trimming their stake in Alibaba from something like 20% of the company to around 15% of the company, locking in a $34 billion gain. So clearly it's not Bridgewater alone that might be concerned about Alibaba. And is this specifically tied to Alibaba? Is it just because of Alibaba's results? You could see the valuation multiple for Alibaba has come in something like 95%, 90%, since it's gone public. So investors are saying this company is worth a lot less from a valuation perspective versus where it previously was. People are saying the growth prospects in the future, it's just not as compelling as what it previously, the previous outlook. And part of that is warranted. Looking at their most recent results, I did a prior video on this saying, look, you have revenue declining slightly and you have core profitability declining significantly, somewhere around 20%. So this is not the same sort of story that you looked at previously, which was strong revenue growth and strong profitability. Now, this arguably isn't just an Alibaba story, though, because when you look at what's going on with Ray Dalio's Bridgewater, they actually exited all of their U.S. Chinese American depository securities. So these Chinese stocks that traded on the American exchange, they blew out of all of them. So then the question is why? And partly I'd assume it's geopolitical concerns. And I don't think that's the only aspect, but there is real geopolitical risk. You not only had Nancy Pelosi visit Taiwan, which greatly upset China, but now you're having additional U.S. lawmakers saying, hey, we don't really care that you're upset. We're going to keep sending in more U.S. diplomats, more U.S. politicians. Once again, not really sure what the upside is here. For me, when I look at this, this strikes me as a very asymmetric, all downside, very little upside sort of scenario. I'm not really sure what's in it for the average U.S. consumer for them to do this. If anything, if this creates the risk of, let's say, a fracturing relationship where a lot of countries in the world have to decide, hey, do I take on Western values or do I accept my number one trading partner, which is China for most countries' case, do most consumers want to have higher cost of goods? In which case higher inflation. And so that's a question that I think is going to play out in the coming years, where does the average consumer prefer sort of the Western values and saying, hey, we want to respect Taiwanese independence and Western values versus being able to buy stuff on the cheap? And that, I think, is a multi-trillion-dollar question that I think people around the world are going to be asking themselves, in maybe the weeks, months, years ahead. I think another core aspect here is maybe, Bridgewater moving ahead of what is likely to be, effectively pressure as these companies delist. It becomes increasingly likely that that's going to happen, especially with these geopolitical sort of fallout. You're even seeing some of these major Chinese companies respond to it. PetroChina, Sinopec China Life saying, yeah, we're, instead of doing this dance over the next 2-3 years, we're going to delist. We're definitively going to delist from the New York Stock Exchange. And that means all these other companies are likely to as well. So if they officially delist, what that means is the exchanges, the ones that trade on the US, they will now trade over the counter. It'll be much less liquid. However, they will have, in most cases, a primary exchange, let's say in Hong Kong. I personally, if I'm interested in buying, let's say, Hong Kong shares, and I do own a little bit of Alibaba in my own personal portfolio. I have about a 3% position in my personal portfolio. If I'm going to buy Chinese stocks, I'll personally use Interactive Brokers just because it has among the lowest costs and it's very easy to do. Some platforms, I'm sort of shocked, don't even allow you to buy foreign currencies, let's say in your retirement account. And so that's, if you're looking to do that to get exposure to countries around the world, that is, an option for you. And so, that's, I think, what most what most of these companies are going to do is say, hey, we just trade on the Hong Kong exchange versus, we'll have this sort of less liquid version on the US. So what's going to happen from here? I upgraded the unraveledinvesting.com website in the last few months with both lower pricing and real-time portfolio updates and easier content navigation. So check out unraveledinvesting.com if you're looking to take charge of your investment journey. And in full disclosure, this is not financial advice. And so what am I thinking? What's Bridgewater doing potentially? How am I thinking about this situation? Well, Bridgewater's co-chief investment officer, Bob Prince, recently posted, some research that I've previously talked about, but here's a chart that I didn't call out, which is this is their outlook based on various different countries' expected real economic growth and expected inflation over the coming 12 months. So real economic growth, that's net of inflation, and expected inflation over the coming 12 months. And they're saying, yeah, the US is still expected to have a negative real economic. So this is a real economic contraction. So the economy is contracting in the US, and they still have high inflation. And this is a real problem because this means if you have a high inflation, the US central bank doesn't have a lot of firepower to help the economy expand. And this is the definition of stagflation, is when you have a situation, high inflation, contracting economy, what can the central bank do? Now, you contrast this and you can look at their outlook. This was, I think, as of June. Their outlook for China is actually real growth of 5%. And effectively no inflation, effectively, less than 1% inflation. So this means based on how Bridgewater thinks China is positioned from a macro perspective, keep in mind, this is a top-down analysis. I usually focus on the bottom up, but I do like to understand, well, what's going on from a top-down perspective. I usually like to focus on individual companies and sort of say, well, what's their value proposition, and sort of say, is this a compelling valuation? So this video is more focused on the top-down, what's sort of going on. Why might one fund be positioning in a certain way? They're one of the largest hedge funds in the world, so it is important. But most of my focus is sort of the bottomed up, focusing on like, hey, what's actually going on with this business? And I call out individual companies, in my letters to Unrivaled Investing subscribers. And so looking at what's going on with China, 5% growth, that is nice. And limited inflation, that means that their central bank does have more firepower to deal with, let's say, economic pressure. So that could be favorable to Chinese securities. So that actually is part of the reason why they've owned Chinese equities in the past, I'd argue, is because it's more of a favorable position than, let's say, US equities, which is facing, a contracting economy and maybe an impotent central bank, which is arguably the inverse of what you're seeing in China right now. And so this is also a chart from Bridgewater where they talk about, look, periods of stagflation, particularly in periods with rising risk premiums, rising discount rates, like arguably we're still facing. The US is still facing, even though inflation came in slightly less than what people expected at 8.5 versus 8.7, which was less than 9.1 last month. That is still really high. Even if it's at 5% over the next few months, like Bridgewater is forecasting over the next 12 months, that is still way above what the Federal Reserve mandate is, which is effectively 2.5%. So this means you're likely going to be in a period that, here's what, Bridgewater has analyzed going back for something like 50, 60 years, saying, look, during periods where there's rising discount rate, meaning the Federal Reserve is raising rates, effectively the discount rate that folks are looking at for how valuing their investments, as well as potentially rising risk premiums, that is generally terrible for risk assets. And a lot of folks saw that this past year, as equities certainly was not spared. You saw a lot of stocks sell off. Yes, so far in the last few weeks, you've seen stocks rallying. I think folks have been focusing on this scenario of like saying, hey, the discount rate might start falling in the future. I think the market's just getting way ahead of itself here, because this is the more likely scenario. Discount rates moving up, the Federal Reserve raising rates. And so this is the concern of like, well, wait a second. If you're in a period where the central bank is still raising rates, that's actually a big turnoff for risk assets, where some other countries, China is one of them, is not likely to be in that situation. There are others that potentially have, a favorable setup that won't be in stagflation, but US, I'd argue, is still in this sort of disadvantaged position where it's not a favorable position to be in. But it is worth, calling out and understanding that Bridgewater, what they post, and this is similar to many, different investors. For example, I've called out Michael Burry, as well. What you see doesn't necessarily represent either what they own in total or their total firepower. You could see, for example, with Bridgewater, about $24 billion of their nearly $240 billion in assets under management. So you can see only about 10% of what they're invested in. So it's very possible For example, if they took their Alibaba stock that was traded on the US stock exchange and they converted it to Hong Kong shares, that is very possible. It's possible that they also sold out. It's possible that they bought, other foreign securities. The reality is, given that you can only see 10% of their portfolio, that means they probably own a heck of a lot of various different foreign assets, or potentially just derivatives or other securities, bonds, that's part of their portfolio that they don't have to legally file. So you're not seeing that. I mean, I've previously talked about Michael Burry, and he at its peak, like over the last 2 years, it was like over $1 billion, and now it's only like $50 million. So that's showing like, hey, risk off for Michael Burry at least. But here, talking about Ray Dalio's Bridgewater, selling out of Alibaba, it's not a clear picture. It's possible that he's buying these assets on, let's say, the Hong Kong exchange. It's possible, especially given that their own outlook, this is their, the charts I just showed says, hey, the US is more likely to come under pressure, and China more likely has a central bank that can do something about economic pressure versus the US, which has, effectively high inflation, and a contracting economy, and a central bank that's going to say, hey, not much I can do about that high inflation unless I want to make the real economic contraction even worse. So if you found this video to be helpful, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.